Largely lower in trade today. We actually have mixed cues, so to say.
So this morning, brace yourself for a big knock on Infosys.
Gross NPA ratio continues to improve and is the lowest in last 9 quarters.
What one needs to watch is also support levels. On the downside, the support for the Nifty comes in at 17,650.
The bulk of the impact in the quarter was from the ramp downs that we saw during the quarter.
The first tick on the index is a loss of about 90 odd points, so not looking good. That's on the Nifty.
We think that the United States would possibly be stepping into a recession, a very shallow recession nonetheless.
HCL have been one of the highest of 8 rupees per kg of CNG.
So Viacom 18, a subsidiary of TV18, over the weekend has announced the completion of the strategic partnership with Bodhichi and Paramount Global.
The Nifty has snapped a 9-day winning streak.
That the insurance regulator has once again looked at the plan again. But it has sort of tried to revive this particular Amazon-like platform called Bhima Sugam.
This is a multi-month low for the WPI data, which had in any case come in at a 25-month low.
Mid-cap side of things, they are outperforming the index.
Well, that was a day so far. You're with us here on a fresh new edition of Closing Bell. We are coming to you from the CNBC TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Bhima, Surabhi, here in the studios. Guys, hi.
Hi.
And Nigel, of course, joining us from the newsroom floor. Nigel, hi, good afternoon. So, we are in recovery mode, I think, very, very clearly. We have been in recovery mode since 12 this afternoon. That was basically when the market hit 17,650, the support we've been talking about since the morning. And then we've not traded below that level since. So we're around 130 odd points, which is a big recovery, a big improvement as compared to the last few hours before that. What is the reason for the recovery? It's what basically took the market lower earlier. It was IT, right? IT is the big pain point, and we'll talk more about this with Bhima. But these are just recoveries, intraday recoveries we've seen on IT stocks. You look at Persistent, 6% off the lows, Infosys 5.5%, Emphasis 3.5%, LTI Mindtree, Tech Mahindra. Many of these stocks are still down sharply on the day, but they are off, in some cases, more than what they are down by on the day so far now. Tech Mahindra, KPIT, HCL and Coforge are some of the other smaller recoveries that we've seen so far. On the Nifty, what this means is, as I said, the low was made at, on your screen, the numbers, the low was made at 17,754. The crucial support is 17,650, which on an intraday basis went. But now, as I said, since 12, we are trading above it. The resistance is the 50% retracement of the entire fall from the all-time high. That stands at 17,857. And I think, as of this morning's open, very surprisingly, the open was around those levels. And then, of course, the first candle itself was a very sharp 100-point downtick. So 17,857 remains the level to be taken out if this market is to go any higher. That's the first resistance in the very, very near term. Bhima, hi.
Hi, and if it wasn't for IT, markets perhaps would be trading in the green. Just pull up that contribution plate. The Nifty is down 130 points. Out of that, 115-point loss is an account of Infosys alone, which basically means 85% of the Nifty downside cut today is purely on account of Infosys. If you put in all the other IT names, and you can pretty much explain the entire fall on the benchmark indices. But the rest of the sectors are doing well, particularly banks. So the Nifty Bank is higher by close to about 0.3%. And here again, it's only HDFC which is struggling in trade. So HDFC Bank is down 1.5%. But the rest of the private sector banks, so whether it's an IndusInd Bank or an ICICI Bank, a Kotak Mahindra Bank, they're all holding up in the green. PSU Banking Index, the Nifty PSU Banking Index is up 2.5% with names like State Bank of India. So even in the banking pack, it's only an HDFC Bank which is struggling in trade. The rest of the banks are holding up. Even mid-cap banks like RBL Bank, South Indian Bank, UCO Bank, all of them have very smart gains going for themselves. So banks as a pocket is looking up in trade. And finally, FMCG. The Nifty FMCG index is up nearly 1% with names like Britannia, ITC, HUL batting for the bulls.
Oh, yes, absolutely. Rima, you said it. I think the FMCG big boys are doing a lot of the heavy lifting and the fighting, and banks like SBI, they're also adding to the sentiment. Mid-caps actually are relatively better off, you'd have to say that there's a minor green, at least on the mid-cap index. The breadth of the market is absolutely even, Steven. And for the time being, at least, the market has followed the script. it has tried to be a buy on dip sort of a market, and that buying trend continues. Now, it's still a long way off. We're 130 points away from the green line on the Nifty, so hard to say if this can happen immediately. But overall, globally, I mean, sentiment is okay. We've had minor gains in Asia. Chinese markets have done very well. European markets are looking at more incremental gains. The US banking numbers that have come out so far were good, both JP Morgan and Wells, and it's going to be more about Morgan Stanley going forward, Bank of America going forward. So globally, markets are looking quite all right. It's just that our earnings and this big disappointment on IT is something that the market has been trying to digest. So, Nigel, what would you say? I mean, obviously, it was a pretty hard knock coming back after that 3-day weekend.
Yeah.
But the bulls are trying to do their bit to digest it and move ahead.
Well, even I'm trying to digest that this week is going to be a five-day week. You know, it's going to be a little difficult after
now
good
it's
3
4,
weeks.
Nigel. It's almost one down, just 1 hour left. So let's talk about 4 now.
making it easier, Surbi. That's good. You know, but the Nifty support zone, 17,500, 17,550. I pointed this out even in the morning that the 50 DMA and the 200 DMA, it's in that vicinity. So that's why that's a crucial support, and we have bounced off those levels. The IT index, you know, now we've seen a fair bit of a correction. Maybe it corrects a couple of percentage points more, but, you know, to see it fall, further from here will be interesting, because you want the IT index, given that it has a weightage of high teens on the Nifty, to consolidate around these levels. And just take a look at it. Year to date, or even in the past 1 year, it's underperformed the Nifty. So some part of that bad news could be in the price. Let's see how that plays out. The positive, though, today is let's keep the Nifty at the side. Look at the small cap and the mid cap indices. Both those two indices, they are at the high point of the day as we speak, which is very, very good news. So portfolios will be feeling quite good. Given the Nifty is down more than 100 points still, portfolios will feel good. And take a look at the crisscross lines. At one point of time, you had less than 1,000 stocks that were advancing, but now there's a bit of a fight back out there. And it's almost pretty much even Stevens between the advance as well as the declines. I think briefly we did had more number of stocks advancing than declining as well. So the breadth of the market fairly good. But we have to track the Nifty. So let's focus on a couple of levels in out there. The 17,800 call, well, that's one of the most active in today's trading session. Because that's active, that's telling you at higher levels, you're likely to see some bit of riding. So on the upside, 17,850, that'll become the near-term resistance level. And also the 100 DMA is at around 17,870 odd. And on the downside, 17,550 becomes an important support. So the 300-point range is what we have. Let's see whether or not it's going to break on any which direction. But otherwise, it's been a good trading session for portfolios. Yes, the IT index has, underperformed, but the buy on dips theory is still holding out. Bhima.
Well said. Let's take our viewers now. What's lined up in the next 1 hour on Closing Bell? IT stocks under massive pressure after Infosys reported a dismal set of Q4 numbers. What's in store for the sector going ahead? A quick analysis coming your way.
Cummins in focus after Bank of America Securities downgrades the stock to underperform. Key highlights from that report coming up in our special segment, Standout Brokerages.
L&T is under pressure today. What's ailing the stock? Details coming up on the show.
We'll talk more about the market, the setup, the sentiment, earnings season, what cues we're getting in from the West, all that and more with the N. Jaykumar of Prime Securities. So it's a packed next 60 minutes coming up.
Okay, well, that's what's lined up here over the next 60 minutes. How should you position yourself, though, in the next 1 hour? That's the question. Mitesh is with us with some ideas. Mitesh, good to have you with us here. You know, Thursday, it was not a similar session, but Thursday also, for the bulk of the day, it was looking like it would be a down day. And then the market climbed up, closed in the green. I'm not suggesting we see the exact same thing, but we're off the lows by quite a bit. What's your sense, Mitesh, and what kind of trades would you take?
Good afternoon, Prashant. So I think there's one major difference between Thursday and today. Is the fact that on Thursday, the first hour decline or the first couple of hours of decline wasn't as strong. Now, what has happened today is that, one, we got a very big red candle on the downside in the first hour. And then, the subsequent candles, while we have seen them being green candles, the market is slightly pulled back. Those candles have been very small and look ineffective as against to the bigger candles. So, to me, my belief is that while the overall trend is still on the upside, the near-term trend will be choppy, volatile, and could still see some more shakeouts and, possibly a retest of 75, 75, 80 zones. which is where the 200 average is also positioned. So I think, we will want to believe that 17,820 to about 17,570, 80 thereabouts will be the near-term range. And the market will just be choppy and consolidate. And I think declines, again, for me would be more of entry opportunities on the long side on the index, because I believe that eventually we'll get past the recent highs. But it'll take a few more days, given the fact that I think, today the intraday charts have been shaken and the near-term indicators are slightly on the negative side. So trade on the long side, they use declines to buy into the markets and look for stock ideas which are giving some kind of trends on the upside. And I have identified two of them. Been very bullish on REC and PFC from the long-term charts, but in the near term also, now there are signals of the trend picking up on the upside. So PFC is a buy with a stop below levels of 162 for targets of 175. And REC is a buy as well. Keep a stop at about 120, look for targets of 129.
PFC, REC bullish on the charts. Mitesh, thank you very much for that. Just a quick word on IT as we invite Hemang Jani and Motilal Oswal on the show. While Indian IT stocks, TCS, Infosys, Wipro and across the board seen a very sharp recovery from the day's low, they're still down in trade. In fact, since the beginning of the IT earnings season, that's prior to TCS, that's 12th of April, Infosys has fallen close to about 12.5%, TCS is down about 3.2%, HCL Tech has lost 5%, Wipro is down 3.5%. Stocks like Infi, Wipro, Infosys today have gone ahead and hit fresh 52-week lows. The way forward from here on, the question is about US macros and client psychology. Is the pain going to be short-lived, perhaps for 1 or 2 quarters, or is it going to be more prolonged, which starts hurting FY25 growth estimates meaningfully? Currently, consensus is building in a double-digit revenue growth in FY25. Is that at risk? And secondly, consensus is also building in margin expansion on account of easing supply-side situation. But if there is no operating leverage because of lower revenue, then costs continue to remain sticky. Costs do not come down at the same pace or that as quickly. Therefore, margins may be under pressure or margin expansion may not take place. So this is something that the street is going to be watching out for. In terms of valuation, we've seen Infosys valuations come off since the beginning of the earnings season. Prior to the earnings season, Infi was trading at 21 times forward multiple. Post their Q4 numbers, EPS cuts have taken place, plus an PED rating. So valuation multiples for Infi have come down to 19 times. So the discount to TCS has only widened further. But there are a lot of earnings expected in the next couple of days. That is the IT earnings calendar. We will continue our discussion on IT at 3:30 p.m. We've got Ravi Menon of Macquarie Group also joining in, and he's a big bull on Indian IT. So he's going to provide the other side of the argument, whether this is a structural or is Q4 an aberration. So keep watching CNBC TV 18. Right now, let me invite Hemang Jani, retail equity strategist at Motilal Oswal Financial Services, on the show now. Hemang, would you believe Q4 is an aberration? The structural drivers for Indian IT continue to remain very promising, and therefore, is the current dip a buying opportunity, or would you wait it out?
Good afternoon, Rima. I think definitely the numbers that have been out, TCS and Infosys both, there is definitely a sense of disappointment, more so from Infosys. And while many investors are, a little disheartened by these kind of show, what we must remember is that in terms of valuations, we are reaching a value zone. And while the external environment is, bit not clear, typically, we do not see this as a material event which would change the earnings big time for majority of the IT companies. So we think that for those who are looking out for a medium to long term kind of an investment, TCS in particular provides a great entry point, and we will have to wait out for the numbers from some of the mid cap IT companies, because Rima, what we must also reckon that the mid-cap IT companies is where the valuations were on a higher side. So depending upon how they show on the numbers or the guidance, the market would definitely react. But there is no point getting incrementally negative at this price point for some of the large cap companies.
Okay, so no point selling in any further. I guess that's Hemang's view. Hemang, afternoon. Just want to get your thoughts on the move that we are seeing towards the FMCG side of the market. I mean, as we're speaking, Nestle is up about 4.5%. These are large stocks we're talking about. Britannia, a couple of others also finding, quite a few takers. Could this be because of some money moving from IT to FMCG, or is it a specific FMCG driven kind of a rally? Just your thoughts on what we're seeing today and whether you would buy anything in the FMCG basket.
Yes, Surbi, part of the resilience or strength that we are seeing in FMCG has to do something with the sell-off in the IT and the money rotation that has happened, let's say in banking and FMCG and maybe some other sectors like auto. Also, the fact that FMCG as a sector has remained quite dull for an extended period of time, and as we are into the result season, some of the companies like Godrej Consumer, Britannia, to some extent Asian Paints, where the number expectation is slightly good and the actual volume growth may not be that bad. So people are kind of taking, some nudge over there because of the result expectation. Overall, we like some of the names like Godrej Consumer. We do like Britannia. I think Nestle also we are seeing a fairly good amount of resilience. So it would be prudent to have some exposure to some of these names.
All right. Hi, Hemang. Good afternoon. Hemang, what about the gold financiers? Some of these Manappuram, Muthoot, they've seen a good rebound from the day's low. Of the banking bank is something that you like. Then CSP, which has closer around 45-50% of its book towards gold, which they're looking to reduce. Well, that as well is making a fresh 52-week high. In fact, we just pull up a last one-year chart, we pull up a year-to-date chart. CSP has already made a 52-week high and it's outperformed most of the Nifty Bank. Any view on these stocks, either CSP or the other core gold financiers?
So, Nigel, Manappuram is something that we like in terms of valuations, and partly because of the gold prices, and more so because of the this recent RBI move not to hike the repo rate. I think the NBFC sector could go through some sort of a re-rating in a positive way because of that. And we do think that Manappuram, because of the core book being in good shape, valuations being much lower, somewhere around 1.15, 1.2 price to book, and gold price being where it is today. It makes some good case for allocation over there. Though it's a mid cap company, so one can't really take a very big aggressive exposure. But yes, as a mid cap company, it makes sense to have some exposure.
Welcome back. Well, the headline index is more or less unmoved, holding around that 17,700 odd mark. But from the broader markets, a couple of stocks are bucking the trend. So you have LIC Housing Finance, maybe a proxy to the real estate theme. That stock was trading more or less flattish. Now that's moved to the high point of the day. So intraday chart comes up for you on that one. And I don't know what's gone on with Tata Chemicals, but in the last few minutes, the stock has suddenly moved lower. And now it's down at the low point of the day, correcting closer around 3% from the day's high. The intraday chart will give you a better picture on that front. But let's focus on the standard brokerage of the day. And Nimesh, at the start of the trade, well, he tells us one brokerage report that he's picked out. Nimesh, today it was Cummins, and clearly the street has taken note of it. The stock is under pressure.
Exactly. If you look at outside of IT, this is one big large cap name, which is a big loser in today's trade within the FNO basket, and largely on back of the BOFA Securities downgrade the stock to underperform from buy. And they've got the target price to 1434 versus 1758 earlier. Now, they've highlighted 4 key reasons why they've downgraded the stock to underperform now. First being 50% of price hike in the updated CPCB 4 plus norms will lead to a big impact in terms of sales from Q1 of FY24. So that the sales impact is going to be much higher according to the BOFA note. Second, FY24 and FY25 estimated EPS growth of 15% and 70% is baking in the pre-buys. On back of this order, they're expecting pre-buys to happen, and that's already been in the price. And at current valuations, there is no much room for upside. So that's the second reason. Third being exports. Now, 1/3 of the sales for Cummins comes from exports, and that they feel could be a disappointment on the back of global slowdown. And the fourth, the bulk of the margin expansion. Cummins has been one of the stock where there has been a 560 basis point margin expansion in the last 6 quarters, and that seems to be behind now. So on back of these 4 reasons, they've cut the FY24 and FY25 estimated DPS by 2%, but the bigger cut has come in the PE multiples. That they've cut from 30 times to 25 times. So on back of all this, a downgrade on Cummins, and they've cut sharply the target price to 1434. I was looking at the sell-side analyst. 17 of them are on the buy side. There are only 4 which are having a hold, and there are 4 who have a sell recommendation. So this has come as a big surprise for the street, and hence the stock is down 3.5% in today's trade.
Thank you very much for that. 60% of the market is bullish on Cummins, and the stock is down pretty well. It has come off today. It's off 12% from its 52-week highs, but it's still up 38% in the last 1 year. Hemang, which side of the camp which side of the fence are you on when it comes to Cummins? There are some headwinds, as Nimesh pointed out, risk of exports slowing down, etc. Where do you stand on Cummins?
So, Rima, I think there are certain reports saying that the export sales is at risk and the new emission norms will have some impact. But I think what we must understand is that, given the technology prowess of Cummins and the kind of market share, we will have to wait for the actual numbers and, some sort of a clarity from the management before taking a view there. Also, export side, it's not as if that there's a broad-based slowdown and there's going to be a material impact. But we think that within the capital goods space, it would make sense to go with the names like L&T or to some extent some of the defense names where the revenue visibility is far more stronger. Whereas in case of Cummins, there are a lot of moving parts. And the stock has actually run up in the last, let's say, about 6 months or so. So I think it makes more sense to go with these names.
Okay, that's a take on Cummins. Stock under pressure, about 3.5%. Infosys, by the way, at least has reduced its cut to a single digit. We were dealing with a 10 to 11% cut right from the morning all through the first half afternoon. It's still about 9.5%, just trying to make light of things. So that's the story for you. By the way, there's been some collateral damage of all this IT selling on L&T as well. L&T is down, the biggie. Let's go across to Vivek. Vivek, so what's the word on the street? Is it just some sentiment rub-off? Because obviously they have these, IT subsidiaries that perhaps the outlook is a little cloudy. Or is there any fresh news flow on the core business as well?
Well, absolutely right. It's mainly based on the kind of impact that the company's IT subsidiaries have. And what we've actually done is we've gone ahead and analyzed, the kind of holding that L&T has in its subsidiaries and, how exactly our valuation multiple is moving, given the fact that just last week, L&T was flirting near its lifetime highs. So the first thing, if you're talking about the kind of performance L&T has seen compared to its, its own IT subsidiaries and compared to the Nifty is down around 2.3% this year. L&T is up almost 6%, and this is despite the fact that LTI Mindtree, has fallen 1.5%, and LTTS is down almost 9% for the year, thus far. So, what this actually implies is that the L&T's core business valuation multiple has actually expanded quite significantly, and this continues on the trend of 2022 that we've actually seen. So L&T's core business is now trading at a much higher multiple given the fact that the IT subsidiaries have significantly underperformed. So now JP Morgan in a note dated April 11th has actually gone ahead and said that the core multiples of L&T have now gone ahead and have re-rated to 24 times 1 year forward versus 22 times 1 year forward. And in fact, now what they're saying is that the order inflow beat is actually now already priced in by the markets, and now the focus goes into the core margins that the main business puts in. Morgan Stanley, very similar lines. In fact, what they've gone ahead and done is they've increased the PE multiple for the core business to 25 times from just 20 times 1 year forward that they were ascribing to it earlier. So now when you're talking about the SOTP valuation of L&T, the core business of JP Morgan actually with a target price of 24.80, the core business 1,646. LTI Mindtree, where it has almost a 69% stake, they are giving it a 552 rupees valuation to the SOTP, and this is after giving a 20% holding company discount. LTTS, where they hold almost 74% stake, they've gone ahead and given 161 rupees, contribution to the SOTP, and L&T Financials as well as development projects, they've gone ahead and given. So on the back of this SOTP calculation, what we can safely assume is that for every 5% downtick in the market cap of LTIM as well as LTTS, there's almost a 1.5% to 2% impact as far as the share price of L&T is concerned, which is what is getting reflected in today's trading session.
Okay, got that. Thanks very much. That's very helpful analysis, Vivek. Thank you for bringing it up to us. What a story it's been in the market. Let's pull up the 1 year performance on both the stocks. Infosys on one hand and L&T on the other. It's that kind of a market. Infosys is down about 25% and Infosys down 28%, beg your pardon, and L&T has soared 25%. Guys, I thought I'll retire before something like this happens. You know, when you see an L&T a year where L&T moves 25, 26%, and Infosys, an IT giant, is actually on the declining side by an equal measure. Hemang, L&T, fantastic run in the last couple of months. More to go. Would you still be a buyer?
So, Subhi, I think this entire SOTP-based analysis that Vivek presented, what we must bear in mind is that, yes, the aggregate value in the SOTP, on an SOTP basis for L&T, for these two companies is about 650 to 700 bucks, but that is more of a strategic nature. Also, the fact that the stocks or the stock prices are near value zone, so I do not think there is a case for a significant derating. Once the results are out, maybe there is some reaction. But the core business, which is ENC and the hydrocarbon, is doing pretty well. And we think that this capital goods was the only space where we did not have any material correction. So now that the stock has corrected for this reason, I think it presents a great opportunity for people to participate.
Okay, Hemang, we'll leave it there. Thank you very much for your time. Appreciate you joining in with that perspective. N. Jayakumar is now joining us. He's Managing Director at Prime Securities. Jake's great to have you with us here. Good afternoon, and thank you for your time. You believe that what we're seeing with the IT services space today, even after the recovery, stocks are down quite a bit, this will funnel money into some of the under-owned parts of the market. Capital goods, engineering, manufacturing basically is a theme which should do well. It's a sector you've liked in the past as well. So I just want to start there. Your thoughts briefly on what's happening with IT and whether we'll see names like Infy, etc. being dead money for 6 to 12 months. And second, what does it mean for other under-owned sectors? Go on.
Well, thank you for having me over. And yes, that's a correct observation. My orientation has been towards manufacturing, especially over the last, I would say, a few quarters. The fact that IT is taking a backseat now, a lot of these companies had, as I said, an ongoing set of orders which kept the last 2-3 quarters, to my mind, optically higher than they should have been. To some extent, I think the slowdown is now really beginning to bite. And I think the next few quarters could actually see them having more headwinds than has even been seen as of now. The good news is that a lot of the cost arbitrage continues to happen out of India. So maybe they are protected a little more in the fall compared to a lot of the other IT players. And my own assessment is some of the mid-cap players could actually lose out a lot more. The mid-cap IT names were going at valuations that were significantly beyond beyond historical averages, etc. And they will correct, as indeed will the frontliners. The frontliners offer defense to the extent that there's lots of cash in their books. They've been doing buybacks, etc. But even more recently, buybacks done haven't helped the stock to be at those levels. In fact, they are significantly below buyback levels they've done even a year ago. So from that perspective, it's a sector that I will avoid. I think there's a lot more bad news in terms of either orders getting retracted, etc., coming through, and I would not want to be in that space. The money which is there currently could and will move, to my mind, to the manufacturing space, move especially to the capex space into the run-up for the elections. I see a lot of projects being announced. I see a lot of private sector capex being announced, and I see money being spent in that area. So clearly, one of the favored sectors will be the manufacturing and the capital goods. And from an export perspective, because a lot of people also had this dollar rupee weakness in mind, I think the pharma, which has been under-owned and unloved in a manner of speaking for the last now few years, I think pharma will begin selectively to see a lot more money flow come through. And even on a basket basis, money coming through to the pharma space is clearly on, and that could come out of IT. Both these spaces, manufacturing and pharma, could be benefited at the expense of IT.
All right. Hi, Jakes. Good afternoon. Unloved has been pharma, but I think what's been loved and what's been spoken about so much is ML and AI, artificial intelligence, and it seems that you're as well interested in that space because, Prime Securities, are just looking at the BSE disclosure out there. You've gone ahead and bought a UK-based company. In a minute or so, if you could just explain this to us. It appears it's a fairly large dilution, but what is the potential from here?
So I think one thing is very clear that in the services space, and I think we need to just step back to understand this. In the services space, the disruption will come from technology. Any growth, whether you take any of the manufacturing spaces, the output is directly proportional to the money or capital that you spend. Technology is the only space, especially the product space, where the output can be asymmetric, non-linear, and granular, as long as your cost of customer acquisition is kept low. So the cost of customer acquisition in this case, in the case of Bridgeweave, has been kept low because it's a B2B2C model. So what does Bridgeweave do? Essentially, it's a manufacturer of, and it's a 5-year-old company, which has put together products in the artificial intelligence and machine learning space, which actually is at the extreme end of technology. It is new age technology. These are but terms for the moment for most people. But this company has been using these. And the interesting thing is there are products of this kind available in the world, technologies which are, we loosely call them algo, quant, etc. But essentially, use of AI and ML is being done by people. But interestingly, that space is entirely dominated by people like the D.E. Shaws and the Renaissance Capital or Citadel Securities or maybe a couple of the big bulge bracket firms who use it exclusively for proprietary investments. That's the important thing. Even as a recent SEBI report outlined to you, if 100 people traded last year, 89% people lost money. And what the report didn't tell you is about 7 or 8% actually broke even. And maybe 1 or 2% people made money in trading on the exchanges. So what Bridgeweave is attempting to do is not keep this the domain of only certain exclusive bulge bracket and hedge funds, but actually use this to democratize investment decision making. The good thing is this is not easily replicable. People who develop this over years and years and years and multiple hundreds of millions of dollars spent use it for proprietary. First time in India, it's going to be available, to my mind, for the retail investor, where we intend going through, I say we, when the transaction gets completed, going through brokers, intermediaries, wealth management platforms, with a view to making this available for the retail individual, whether it's a long-term portfolio, medium-term portfolio, thematic portfolio, short-term, any of these, multiple products are being put together. We're also at the moment on a couple of international platforms. And therefore, this market, because they track about 4,500 stocks worldwide on a day-to-day, minute-to-minute dynamic basis. In fact, one of the medium-term portfolios called Equity Rocket actually generated close to 58% return last year, when the Nifty generated just 4%. So these are the kind of, and the reasoning is very logical. If a machine that's constantly learning, improving, factoring 800, 900 factors simultaneously to make decision-making, by definition, intuitively, it will be a superior decision-making to lay individuals who are going on quote-unquote khabar, what's the news of the day, etc. So the idea is to democratize sensible decision-making as an aid to generating consistently superior returns as opposed to the maximum return. In fact, the big thrust in this is to have low volatility for people who generate, who use this portfolio, and they would find returns being consistently better than a far higher probability of success and certainly a better probability of not losing money.
So you are looking to disrupt the stock picking space with AI and ML. Jake's afternoon. Which are the other sectors which are on the verge of disruption or likely to get disrupted? You know, we had NGS, the CEO of TCS, saying every client conversation begins and ends with what generative AI can do for them, right? According to you, in the next 3 years, which sectors stand the risk of being obsolete or getting completely disrupted based on technology? A 3-year, 5-year horizon, according to you, in the listed universe.
At the end of the day, the chat GPT as the product, for those who've used it, I mean, and I use it very, very regularly, actually is eliminating secretarial. It's probably the most efficient secretary you can have in life. Over a period of time, you can actually modify this, and you should wait for chat GPT 4 to come through, because that essentially starts processing and use of a whole bunch of APIs and tools that are given to you on a quote-unquote leased basis. Because the entire concept of open AI is exactly that. It's open to everybody who can't make these decisions, who can't make these big investments. And therefore, these tools come up where each person can actually fine-tune his or her own business. So I think the big sectors that you talked about, things like media and entertainment, things like any services business, could actually get much finer inputs from an assistant who constantly is learning your business and constantly, I mean, for starters, they write the best English there is. They write the most logical sequencing of English sentences. So it actually is thinking for you in what I would consider a refined, more importantly, the next generation way. So the efficiency of the business and the fact that, I would say, technology at its core, the services business, the body shopping, if you will, could be the biggest affected, because a lot of this is actually available. Lawyers can get better assistance with this. Doctors can get better assistance using AI and ML tools. So these are all service related, which can actually, and at its heart, what is it? It's actually nothing but a bunch of high-powered programmed machines learning to get better and better and better, learning on a daily basis, incrementally improving their knowledge level, and to the extent you can give it, fine-tuned, honed to inputs, they'll give you far better output. That's exactly what it is.
Jakes, hi, good afternoon. Surabhi here. Hi. So, those are very interesting observations and thoughts on AI. I'm going to steer things back to the market now because here, whether it's artificial intelligence or human intelligence, no intelligence seems to be working, right? Everybody's struggling to find out what next. I don't think we're any wiser. We've got range-bound dollar, range-bound US bond yields, but now they've kind of tamed down to about this 3.5% sort of pivot level. Everybody's saying another 25 bips from the Fed, then the Fed will pause, but then there is a recessionary fear ahead. But I think one of the most telling things as a takeaway from the IT earnings, forget those companies, is that there's something far deeper. It's not just two big banks or two mid-sized rather US banks blowing up that caused this kind of a disruption. There is disruption happening in other parts of the US economy, and it's pretty evident in the way those spending decisions are being taken, right? So coming back to the markets, where do we stand? And what are we looking at, let's say, over the next 6 to 8 months?
Let me point out a couple of paradoxes that are there in the market. This is the first time in 3 to 4 decades, that the US dollar is not the safe haven destination when there's a crisis. In fact, this is the first time that the US dollar is noticeably weakened during a crisis, number one. Number two, this is the first time that people seeing the disruption in bond markets, disruption in other markets, have rushed to hitherto seen as dead or uncertain asset categories. People have gone into Bitcoin, which means that the de-dollarization theme from a market is actually gathering storm, where people are saying any asset where tomorrow there could be use of that asset from a trade or transaction perspective should be bought into. The entire trend of people like India and China using the yuan or the Indian rupee for bilateral trade is taking shape much more. Maybe it's a few countries today, maybe more and more countries will come in. As it is, Russia is supplying oil to India, Iraq wants to do it at prices well below the sticker price, which your commodities team covers every morning. So we might see an $80, $85, but I can tell you all Indian oil companies buying Russian or Iraqi oil are doing so in the early 50s or late 50s in terms of pricing. So the concept of individual bilateral currencies or currency is already gathering storm. So that is the one big trend. The second big trend, again, most paradoxical, is the equity market volatility did not go up anywhere close to the extent that it used to during 2008, etc. Imagine you're talking about Credit Suisse, you're talking about SVB, banks collapsing. Yet the index, the volatility index actually remained in well and truly sane levels and well below the GFC highs. Number three, the fact that people rushed and the Nasdaq was the best performing index means that people found the balance sheets of the Apples and the Googles and the Microsoft far safer to go to, because from a reserve perspective, they probably have cash reserves higher than what most countries in the world do. So from that perspective, these companies were bigger safe havens, paradoxically, because the Nasdaq yielded 17%, and while other asset categories collapsed and the dollar actually declined. So I think there is every time it's different, they say. And the difference is that at some point in time, the equity markets actually turned out to be a greater safe haven than a crisis would have you believe. And I think from that point of view, because whether it's politically, whether it's economically, or on reasons that we talked about, the Indian macros are very, very strong. I think the FX reserves position is strong. Our bilateral positions improving, and retail is constantly putting more money in. Our dependence on FI is down. FI holdings are at virtually 15-year lows. So from all these perspectives, I think we are very, very strongly positioned in India. We may go through a period where we are overvalued compared to historical averages, and we may continue to be for the next few years. But I see strong retail flows continuing to buttress the markets. And at one point in time, maybe the foreign investors returning. But to me, the combination is, and with so few IPOs around the corner, anyway, large, meaningful IPOs, the fact that the secondary markets are benefited is a truism.
Jakes, thank you very much. Appreciate you joining in. Good luck with that acquisition and speak with you soon again. Thanks indeed. And Jay Kumar at Prime Securities. The market's down 115, which means that even from when we started at 2:30, we are up a little bit. It's a steady incline upwards. Not a very sharp incline, as you can see on the graph, but it is an incline nevertheless. We'll take a quick break here. On the other side, we'll get you what dealing rooms are talking about. D Street Chatter with Nimesh.
Welcome back. You're tuned in to Closing Bell, and we are coming to you live from the CNBC TV 18 Motilal Oswal newsroom. Well, the broader markets are doing quite well, and one such stock that's moved to the high point of the day is Ethos. That was locked in upper circuit with a gain of close to around 20%. I don't know what went on there, but in the last 1 hour or so, that stock has spiked up. And KDDL, that's another listed company. It still holds close to around 51% stake in Ethos. So that one as well could be on your radar. Keep an eye out on this one. The reason we are spotting KDDL is because it's the promoter entity of Ethos, and Ethos is the stock that was briefly up close to around 20% or thereabouts. Well, it's time now for our special segment. Nimesh joins us. Nimesh, tell us, what are you picking up in D Street Chatter? The headline index may not look good, but it's been a good day actually for the broader markets.
Well, Nigel, a good day for the broader markets, but though the markets have recovered from the lows, the institutions are better sellers. That's the key message from the large daily rooms, that there is selling pressure. Of course, it's dominated by technology names, but even having said that, there is some bit of recovery in the mid-cap IT names for sure. Look at Persistent, for example. That's recovered almost 6% from the day's low. So while flows are negative, there is a bit of recovery as well. I guess the next 2 weeks are going to be very, very important from a technology point of view, though from the Q4 earnings commentary as well as the flows as well. Looks to me like, today's selling is not over. The kind of flows which have been reported by larger institutions looks like that large selling pressure may just continue for the time being. And so individual numbers will be very important within the IT names. As you rightly pointed out, the broader markets have been relatively well. So X of IT, things have been much better. And within that, the one big theme which has played out today is the mid-cap banks. Both PSUs as well as private banks have done well. Even something like an NBFC like, AB Capital has done very well today and on good volumes as well. So there is some bit of money getting changed now within the financial names. That's the overall feedback. On the technical side, 17,850, 17,900, we've been talking about it, is a big resistance on the upside. So that's the level to watch. But I guess today's, while recovery has been smart, the FIs are better sellers. And the big theme would be the flows and the news flow in the technology basket.
We'll watch out for that data point, Nimesh, because last 10 sessions, the FIs have been showing us the money. Maybe they're taking their foot off the pedal a little bit in the near term. But what about individual stocks? What are you picking up?
So today, the first stock on my list is Infosys. That's one stock which has hardly recovered from the day's low. And there are good volumes as well. And I believe there is strong FI selling in that particular counter on the back of weak Q4. So today's FI number will also get skewed because of large selling in the IT basket. So that's something to track. The second stock is Bombay Dyeing. That stock is buzzing in trade and on good volumes. And I believe the street is anticipating some sort of a monetization of a land bank. And that's the reason why that stock is buzzing in trade today. So that's the second one. The third stock is NTPC. Within the PSU basket, this is one stock which is under pressure and on good volumes. Over the weekend, there was BofA Securities downgrading the stock to underperform. So that's putting some pressure as well. I guess, the big trigger to watch in NTPC would be the monetization of their renewable energy assets. That's been going on for a while now. So Q1 is when Street is expecting something. So that's something to track in NTPC going forward. And the last stock is Z Entertainment. That stock is under pressure today. We had a clean out trade wherein Invesco sold out its entire stake. So that supply overhang is out of the way. But I guess the bigger reason is, looks like the way the NCLT hearings are going on, the merger process may take another 3 to 4 months. And that's the reason why that stock, even after the clean out trade, is under pressure today.
Okay, thank you very much for that, Nimesh. Let's Take it away to Mitesh now to get in a technical check on the markets. The Nifty is back above that 17,700. Mitesh, that buy on dips has really worked today. But at the current juncture, from 17,700, can someone go long? And what would be your BTST calls?
So on the index, I would advise that because, my belief is that with today's breakdown on the hourly charts, while there's a good pullback and because the bigger trend is on the upside, in the short term, there's a stronger and a much more superior possibility of markets going into consolidation. So if somebody's has just bought today at the lower levels, Australia stop loss is about 17,650 on the spot, which is about 63 odd points lower. And as you get closer to 17,800, try to exit long positions. You will see a few days of sideways activity and broadly a range of about 17,820 to about 17,550, 560, which is also the 200 average area. And I think, we have to now be trading with more of range-bound strategies, which means that buying at lower levels and selling near to the upper end of the range. Having said that, on the stock side, Coal India is a BTST. I would recommend this one to be bought for a day or two with a stop below 227 for targets of 235. And the other one which I like is AB Capital or Aditya Birla Capital. It's moved up in the last few minutes a bit more, but still a BTST with a stop at 161 for targets of 170.
Okay, got that, Mitesh. Thanks very much for the trading strategies there. The market 17,700 is back on the screen, so it's a real big effort from the bulls today in terms of fight back. They're still about 100 points away, 120 points away from the green line, but nonetheless, it's been a day of steady buying at lower levels. Well, with that, let's shift the focus to an exclusive story that we're tracking for you here on CNBC TV 18. Sources are telling us that IRDAI has revived its plan to launch Bhima Sugam. That was said to be an Amazon-like platform for insurance products. Yash has the details. Yash, what's the latest?
Well, that's correct, Surabhi. So it almost feels like, the insurance regulator trying to breathe life, re-attempting to breathe life into Bhima Sugam. As you correctly said, it's an Amazon-like platform for sales, servicing and claims of insurance policies. What we've been given to understand from our sources is that the Insurance Regulatory Body Chairman, Debashish Panda, very recently met the CEOs of life and general insurance company. And as far as this particular meeting is concerned, a broad framework, but an important one for Bhima Sugam was discussed. What we've been picking up as far as details are concerned is that the insurance regulator is expected to come out with RFPs or requests for proposals, inviting applications from service providers who would be responsible to sort of put this platform together and the structure of it. Also, what we've been given to understand is that the Life Insurance Council and the General Insurance Council will own 45% stake each. As far as Bhima Sugam is concerned, 45% stake with LI Council means all the life insurance companies will have stake in equitable manner. Same goes for the general insurance companies. As far as balance 10% is concerned, that could be given to service providers, policy aggregators as well as agent body. Also, what we've been given to understand is that Bhima Sugam could look to raise an initial capital of about 100 crore, which will come through selling stake to all these insurance players. And as far as operational expenses is concerned, Bhima Sugam could charge a fee to all insurance companies on every transaction, which may include sale, renewal, servicing of policies. Not just that, also on every inquiry, a particular fee could be given as far as insurance companies to the platform is concerned. The implementation could happen in 3 phases. The first one, it could act as a platform for data for all insurance companies. In the second phase, standard products could be listed on the platform. And the third one, all blanket products could come on the insurance servicing platform, that is Bhima Sugam.
Okay, all right. Yash, thanks so much for joining and giving us a quick update. And Yash has been on top of the story, so we'll keep tracking it for all of you. Well, independent market expert Amrish Balikal joins us on the show. Well, Amrish, we have spoken a lot about IT and various other sectors, but I'm throwing this across to you. This is a market where you're getting some entry opportunities. So any stock that's on your radar?
Good afternoon, Nigel. The stock which is on my radar is Narayana Hrudayalaya, which anyway I recommended earlier also, and it's reached the target price. I'm again revisiting that stock. The company has about 47 healthcare facilities, out of which about 22 are hospitals, about 21 are primary health facilities, and 4 heart centers. Nearly about 6,400 beds, of which about 6,100 are currently operational. And they have about 4,000 doctors on their rolls, which actually gives a bed to doctor ratio of 1.5, which is considered extremely good. I mean, if you look at the capex, it's among the lowest in that category. I mean, the cost per bed is about 40 lakhs. whereas if you look at the competition, it's anywhere 70 lakhs plus. They reported excellent numbers with consolidated your 9-month FY23, which is of December. The revenue was more than 3,300 crores, so which is about 20% Y-on-Y growth with improved contribution from the new hospitals. The Mumbai hospital has shown break-even, whereas we have seen positive contribution from the 2 new hospitals in the NCR, Dharamshila in Delhi and the Gurugram hospital. So overall EBITDA margins, if you look at, it's about 21%, which again has been moving up steadily last couple of quarters. And if you look at the capex, they have incurred about 680 crores in the last 3 quarters. I'm assuming they would have spent either 320 crores in Q4, where I think the earnings should come possibly over the next 2 to 3 weeks. Because they are guided for about 1,000 crores in FY23, and now they are guiding for 1,000 crores capex in FY24 also. So I think there'll be, extremely good growth visibility which is there. And if you look at the Cayman Islands hospital, that was a bit of a bother in the last couple of quarters, but then they too have contributed about 18% growth in the last 9 months. So expecting the oncology block to commence operations in Q1. FY24, which is the current quarter. So the management seems quite optimistic. And close to 50% of the capex for FY24 is actually earmarked for this facility. So looking at an EPS of about 32 for FY25, and I have a target of about 960 for this stock.
Few minutes to go before we close for markets. After Infosys, it's Tech Mahindra which is going to go down as the biggest Nifty loser with a cut of 5.2%. The key concern, as flagged off by Citi, is that Tech Mahindra has a very high contribution, 40% of its revenues coming from the telecom or the communications vertical, where both Infy and TCS have seen a revenue decline. And the revenue decline has been quite sharp for the telecom vertical, which raises the possibility of very large headwinds for the communication vertical for Tech Mahindra, which is why this stock has seen a big decline in trade. Ambarish, very quickly, thoughts on Tech Mahindra? Anyway, its margins, it operates at lower margins compared to peers.
In fact, we've been quite cautious on the IT space overall. I think we had discussed this last Wednesday when I was there on the show, saying that the earnings would be disappointing. So, in fact, I didn't have a buy on any of the large IT names, except I had a buy on Tata Elxsi and KPIT at lower levels, because I think at that time it was quoting at about 920 levels, about 2-3 weeks back when we had discussed about KPIT. So, that closer to about 680-700 levels, I'm a buyer. Tata Elxsi, even at the current levels, it's a decent buy. But when you talk of the other IT names, the large names, despite the correction which you have seen, I think we should wait for at least another 5 to 8% further correction in those stocks.
Okay. All right. Amrish, thank you very much. We'll leave it there. Appreciate you joining in. We've got about 2 minutes to go for market closing. And it's going to be, I dare say, a good close, a decent close. We're down 125, but up 100 plus points on the day's low, which was made early on at 10 this morning. The picture looked very different as compared to what things are at now. Banks did much better. The Nifty Bank, by the way, the reason I'm saying banks have been doing well as compared to the Nifty is because while the Nifty is not even at the 50% retracement of the full fall from its all-time high, the Bank Nifty is basically taken out at 61.8% retracement. Even last Thursday, it's been above that level, and it's another close above that level for the Nifty Bank. The PSU Bank Index did the most in terms of gains today. The Nifty PSU Bank Index ending about 3.25% in the green. You can throw in the FMCG and real estate indices as well, which are the other gainers that we had today. But IT, Arima, is the big one, which was the reason why markets went into a tailspin early on.
IT index down 4.7 by the close of trade. Even though it recovered from the day's low, the Nifty IT index recovering more than 3% from the lows, it still ends with a sharp cut. Infosys down nearly 10%, Tech Mahindra down 5%, HCL Tech, Wipro seeing cuts ranging between 2 to 3%. On the gaining side, PSU banks led the way. State Bank of India up 2%, but outside of that, look at the PSU banking names. Punjab and Sindh Bank, 18% gain on that. Indian Bank, 8.5% higher. Central Bank, 6% up. Union Bank rallying 5%. So PSU banks have had a solid session in trade. And the other sector which catches your attention are the FMCG names, where the index was up 1%, but heavyweights like Nestle, Britannia, ITC, HCL, all fighting for the bulls. And it's a good comeback, right?
Oh, absolutely. It's a very, very smart fight from the bulls. No taking away from that. Mid-cap market not bad at all. The mid-cap index is going home with gains of just about 0.4%. And the market breadth is actually favoring, well, just about favoring the advances. You can say it's absolutely even Steven as we're ending up. Just some names to end it off. There's a Camlin Fine, for instance, 8.5% up. There's some corporate action there. Promoters are buying stake from the market. V8 Equibag about 10% higher. And IOL Chemicals, Tanla Platforms. Of course, the banks, CSB Bank, Central Bank of India. They managed to put on a very good show on a day when the market was otherwise fairly weak and lackluster. RBL Bank, you can add the banks to that list of gainers as we speak. So all in all, a session where the bulls put up a good fight, and let's see if they can build on this tomorrow. Right now, we will take a very quick break. On the other side, we put the spotlight back on the IT space. That's been the big newsmaker of the day. Ravi Menon of Macquarie is going to join in and give us some thoughts on how he reads the picture now that both Infosys and TCS